found myself digging deeper and deeper into the analysis of the market, a lot more big picture rather than the very micro thing. I think because at this point in time, we have a lot more questions than answers, right? And unfortunately, the answers are not going to come so easily anyway. And there can be many, many kind of scenarios that are going to play out in the next, probably even within the year. There may be major changes. So at this point in time, we only can say what we know and what may possibly happen, and what we don't know may happen or not. Okay, so it's a bit confusing, but it's always like that. The market is never ever clear, right? Because if it's so easy, then everybody would know exactly what to do already. Okay, so I will give you my view, right? Again, it is just a view. It doesn't mean that whatever I say will come true. I hope the bad things don't come true. I hope the good things come true. Okay, so let's hope that is the case. And you may have a different view, right? Which is fine. Okay, as Louis also have his own view. I think that is why we want to give you a bit more perspective. Then you can think about whether what we say has some truth in it or not. And the last part that I want to talk about is more towards like what we can do, right? Because after we talk about, okay, these are possibly what could happen, and how do we then position ourselves against those scenarios? And if we are, and the problem is that we have different risk appetite, we have different objective, we have different kind of situation and circumstances, and there is no one thing that we can all do together in the same way. And which means that you have to think in terms of context. Or if you're not sure, reach out to me or Louis, and we can help you along the way. Feel free to do it, right? Because we cannot just give a very broad brush kind of suggestion, and then everybody with different circumstances just go and do it. I think that is very irresponsible. So I just want to make this clear before we start this session, right? Because we are at a very important juncture. The market is not going to be very friendly to us. It has not been friendly to us since the start of the year. And we need to make our best decision based on the available information that we have, right? So that's what we're trying to do over here. Okay, so with that out of the way, let's go through the things that we are supposed to discuss. And Louis already painted you a good picture of where we are right now, right? Or what has transpired over the last 1 year. And there are some things that you already know, right? Inflation is already taken. Okay, it was still a question mark last year, November, right? But by now, everybody is very clear that inflation is here, and some of us even feel it, whether it's at a pump station or whether you're buying food somewhere from certain stores, right? So the price increase is already real, and we can feel it on our day-to-day life. So that one is taken. The question is, how long will this inflation go on, right? And how will it worsen? That would even be in a worse position than what we are right now. And the second thing is that there is a new fear. The new fear is that a recession might come, which means economic contraction. So your GDP contracts. And when your GDP contracts means that people will lose jobs. And you have price increase and you're losing your income. This is going to be a very bad scenario. All right. And that's what the economists call stagflation. Okay, you're not moving anywhere. Your economy is contracting. And then prices are high, right? So this become a very difficult situation for central banks or even the government to do anything, because traditionally there are two ways to help manage the economy. One is a monetary policy, which is handled by the central bank, and then there's a fiscal policy, which is handled by the government, which is government spending, right? If you want to spur the economy, you can lower interest rate, flood the market with more liquidity, and then the government starts spending. So that is how you boost the economy. But with inflation, you can't do that, right? Because if you pump more money, if you go and pay more for projects, you're going to feel that demand, and then you're going to cause the price to go up further, right? So you're going to worsen the inflation. So which means like dovish kind of policy will not be effective in a stagflation period, because you have both economic slowdown plus inflation. Then on the other hand, let's say you want to deal with inflation, you reduce the money supply, you raise the interest rate, and you stop government spending, then you turn hawkish, then your economic recession will worsen. So you realize that if, let's say, we transit to this stagflation period, right, is something that the government also cannot do anything. And if there is no quick remedy of this situation, which means this stagflation can go on for years. Okay, so that is to me the worst case scenario, right? And if it goes on for a year, which means that the stock market is likely going to suck. And that is actually a secondary consideration, because if we go into stagflation, you will feel the impact every single day. Prices are high, job stability is gone, business is down, right? Revenue is down. So it is going to be bad, right? Stock market is not even a primary consideration. Okay, so that is the worst case scenario that I think could happen. Okay, but later I'll give you a different degree of inflation, different degree of like scenarios, right? Because this is just one of the many scenarios that can happen. Yeah, I don't wish this to happen. And if we want to really study how it is like during a stagflation period, the best period to look back is 1970s, in the US, of course, because that is probably the only time that the world has experienced stagflation, and it lasted for a few years, right? That was the only time, or at least a recorded period lah, that the humans know. So it's not very far back; it's just 50 years ago. Okay, so that is the period that we're going to use as a basis to really help us understand what can actually go on if we really move into this scenario. So US inflation yesterday reported 8.3%. The good thing was that the previous month was 8.5. So actually it went down a bit, but it's not by a lot, right? So people were actually expecting it to come down more, but it didn't. So the stock market sell down again. And today, even the REIT market sell down again, right? Because the fear of the Federal Reserve raising interest rate faster or pulling away the liquidity faster is there, right? So that is the problem that we're facing right now. And this is also known, right? The rates have gone down since 50 years ago. Okay, this is where the stagflation happened. Okay, there was inflation, come economic slowdown, actually, especially in the early 80s. So they use monetary tightening, right? Instead of quantitative easing, they do quantitative tightening. They hike the interest rate. That's why you see the interest rate. Okay, crazy, right? Interest rate, US interest rate last time in the 70s was 20%. Interest rate 20%. Who would go and borrow money? Right? And you don't borrow money, banks don't get businesses, then everything slows down, right? So that's why when you raise the rates too fast, too high, it will cause your economy to falter. Okay, so that was what actually happened, right? In the 70s, they tried to rein in inflation. They raised interest rate to up to 20%, and then after that, they went into recession for 2 years, 1980, 1981. Okay, so you can still lump the whole period as stagflation, but if you go in granularity to look at it, of course, it wasn't really a very clear overlap. Recession and inflation happened together, right? So on a more overview, we just take it as a stagflation period that we will use for our discussion today. Okay, so since then, the inflation, not the inflation rate, this is the interest rate. The interest rate just continue to go down. Okay, low interest rate environment just going to go down. And then the crucial part was during 2008, the interest rate was near zero. Okay, then COVID, interest rate was near zero, right? So the market has a lot of liquidity as well, and they also did the QE 4 times, right? Then now they're on the QT process. So you see there's a 180-degree change in the Federal Reserve policy right now. Inflation is more of a bigger concern than economic recession. Okay, so if they don't get this right, we might fall into recession, right? So that is the delicate scenario that we are at this point in time. Okay, it may sound a bit bearish, but I'm just trying to paint to you one of the worst scenarios, if not the worst scenarios. Okay, it may not happen, right? Let's hope it doesn't happen. So they are going on a QT already. So this is a QE 4 times. Okay, through the years, they bought a lot of things. Now they need to unwind, right? So when they unwind, what they do is that they sell all these assets, and the market need to absorb this, right? Somebody need to buy over from Federal Reserve. Who is going to buy? Okay. And the moment they buy over, the funds will be kept in the Federal Reserve, right? And then it will be probably written off or what. Okay, so they reduce the balance sheet from there. And there can be even other cascading issues, which I don't think it's important to talk about right now, but maybe in the future mentoring session we can. Okay, because US is also very indebted, right? And when they do these kind of things, right, it's going to hurt their debt, their ability to repay the debt. Okay, so the details we'll talk about in the future. It's not the biggest concern right now, right? So the biggest concern is still on inflation, recession. Together will be stagflation. So we are on an interest rate regime change, right? We are going to switch to a higher interest rate environment. We have already seen an increase, but the increase is still actually very slow, right? Just 0.25 basis point, 25 basis point, 50 basis points. These are very, very small number. They've been like zero interest rate for a long time. So I know they also don't dare to increase too fast. When you increase too fast, your economy will slow down, right? So they are testing water, but they may accelerate, right? They may accelerate. So in the 70s, okay, anyway, this POSB one was in the 80s, okay, 7% interest rate, right? That you put in a bank account. This is not like fixed deposit or anything. 7%. Okay. So what do you think? If today, right, DBS offer you 7% on your savings account, what would you do? Will you change? Will you change anything? Will you change the way you manage your money? Come, give some of your idea. If today DBS or UOB or OCBC, whichever of the local bank, offer you 7% on your first $100,000 savings with $75,000, with the first $75,000 insured, right? I think it's $75,000. Okay, what would you do? Would it change? Would it change the way you handle your money? What would you do? Come. Give some suggestion. What would you do? I'll put all my cash with that. If offer 7% means inflation much higher. Yes, correct. Sell 80% of stock investment and deposit into the bank. Okay. Right. This is very common. Okay. So imagine, right? Every one of us sell $100,000 worth of stocks and then we park in the bank account. What will happen to the stock market? It will tank, right? If everybody does it. So you see, right? Interest rate regime change will cause a lot of upheaval in the entire ecosystem. So I think a lot of us are underestimating what is coming. Okay, if let's say the interest rate really go up so much, but if the interest rate doesn't go up so much, then this is not a problem. Yeah, again, I'm painting you a worst case scenario, right? If we really go up in this manner, up to this number, I can tell you people will start selling the risky assets and then park somewhere safe to get high interest. It's like, why would I want to take more risk, right? Because if I buy stocks, okay, you fluctuate, I can still lose money. If I buy crypto, I can lose a lot of money, right? If I buy those risky assets, the risk is just much higher as compared to I just buy in the bank. My capital doesn't get depleted and I get 7%. Why would I want to go anywhere? Okay, with that kind of thinking, that is how your fund flows will change. Okay, so what we have experienced in the last 10 years, as I show you just now, is a very low interest rate environment. It is not normal, right? It is just the past 10 years or so. Okay, and people forgot, right? So this is what I call recency bias, because based on our recent experience, we project forward how the future is going to be like. But maybe the right kind of time frame that we should be looking at is that potentially it can be a 1970s replay. Okay, and this is what it's going to be like. Right, so that is the perspective shift I want to share with you today. Right, it is not confirmed it's going to happen. I'm just saying that there is a possibility. Okay, if inflation continue to stay high, right, they need to bring it down, and then the interest rate will go up. And why would Singapore interest rate go up? Because we don't manage interest rate, right? We manage our currency. We will inherit. Okay, so how our Sing dollar manages is against a basket of currency. And definitely I can tell you USD and renminbi are both inside one. Okay, probably even MYR or the first three, the top three, euro, renminbi, USD, they will all be inside this basket. Although MAS have never declared openly what currencies are inside, they just say major trading partners. But the clue is pretty obvious already, right? The big players are going to be there. And which means our interest rate, right, is not controlled by our government. The interest rate is inherited on. The interest rate is inherited from this basket. So if US is raising interest rate, okay, we will inherit higher interest rate. That is why you start to see the mortgage rate going up. We have no control over the interest rate. Okay, we decided to have free capital flow. We decided to fix exchange rate. So we have to give up the power to control interest rate, which means we will inherit our trading partners' interest rate environment. So one of it, USD being a biggest player, definitely it will hold very big weight in the basket, and we will inherit the rise in interest rate. Yeah. So the next thing is that this inflation, this interest rate will go up. Okay, and let's say we hit in the 80s, okay, we hit 7% interest rate in the bank. The inflation, right, is going to be 10%. Okay, that was what exactly happened in 1980. Okay, Singapore inflation was 10%. The bank pay you 7% fixed, not fixed the interest rate on your savings account. So with this new knowledge, would you change your decision to put money in the bank? How? Would you still put money in the bank for the 7% interest rate while the inflation is 10%? Will you still put your money in the bank in this case? Come, share. Would you do it? Okay, yes, still yes. Lose 3% or risk the market? Yes, correct. Put less, still will put. I mean, definitely we always need a bank account. No, I lose 3% if I live in the bank. Okay, so now some of you will say no already, right? But some of you still will prefer to do it. Okay, one say buy bonds. Some of it, yes. Can't think of an investment that exceeds inflation, right? So it is also again personal circumstances and your ability, correct? So some of you feel that, oh, I can't find another investment that is going to beat this inflation 10%. It's going to be hard. It's okay lah. You know, I get 7%. At least I defray the inflation rate. Okay, not as bad, and at least I get my capital secure, right? So some are thinking like that. Some are thinking that, no, I guarantee lose 3%. Why I want to do that? I'm gonna find something else to beat the inflation. Okay, yeah. So that is the personal circumstances that I'm talking about, right? So there's no one right answer how we're gonna do it, but you can see that all these dynamics, right, will cause people to make different kind of decision. If these things parameters change again, the situation change again, your actions will change again. Okay, so that is the problem here, right? It's very difficult to predict what exactly is going to happen, right? But we go through this thought experiment, at least you know what are the common things that people may do when certain things happen. Okay, so it's not a guaranteed thing that this is going to happen, but at least we run through the exercise. Okay, so what kind of investment did well in 1970s? Right, so there's a crucial question. Okay, so not surprisingly, energy stocks were up. Okay, but there is a caveat. The caveat was that the inflation was also caused by the oil crisis because of the Yom Kippur War in the Middle East. The US was siding like Israel, and the rest of the Arab countries were not happy, and then they don't sell the oil to US and cause the price of oil to go up a lot, right? Actually, it sounds a bit like today lah. Okay, but this time round is US boycott Russia. Russia don't sell oil to US or the rest of the world, right? So that is something similar in that sense. Okay, so energy prices shot through the roof, and then REITs actually did well, right? In the stagflation period, your bonds, which is your T-bills and your treasuries, didn't do well, okay, because rising interest rate. Later we'll go through bonds. Rising interest rate, lower your bond price. They have inverse relationship. Okay, S&P stocks didn't do well, basically. All right, so you can see that during a stagflation period, especially the more dominant one is inflation, a lot of the things that we usually invest in are not doing well. Okay, so that is that paradigm shift that I want to share with you. Okay, because a lot of people just think that the past 10 years, the next 10 years is going to be like the last 10 years. Okay, it may not, right? And I want to prepare you now so that if it happen, it's not a shock to you, and you're in a better mindset to deal with it. Okay, so that is one thing that we need to get out from today. All right. So just understand that energy stock, REITs, all these tends to be a better one, or commodity stocks. And we can, as I said, there's different grades of inflation. Inflation is a broad word. There is different grade of inflation. There is just okay inflation. There's hyperinflation, and then there is a recovery part, which means that you are recovering. You are going down. Okay, your hyperinflation seriousness is going down. Whereas the other one is inflationary recession, right? So this just means that it is at the peak of it. Okay, so you can see that different investment, S&P 500 is the first bar over here. So I just circle for you so that you can see this clearly. Because the chart, they plot it a bit misaligned. Okay, it looks like that. Okay, it belongs to this and this belongs to this. All right. So the different color bars that you see, the very first bar on the left will be S&P 500. Then the second bar will be precious metals, which is mainly gold. Then the third one is energy. Fourth one is industrial. Fifth is agriculture. Then REITs. Then infrastructure. Then US 10-year bond. Okay. So in normal times, let's focus on this first. We can forget about the deflationary. Let's look at the normal times. Normal times, your stocks do well, right? Normal. Your energy also decent. Your industry also decent. Basically, still stocks are. REITs also do well, right? Infrastructure stocks also do well. Bonds is just small return, right? Exactly what we have probably experienced in the last 10 years. Then we come to the inflationary period. I think this is where we are. Here, now. Okay, so this is where we are right now. And then you can see that it is the energy stock that does very well, which is true, right? The energy stock has done very well for the past maybe 6 months, right? 6, 7, 8 months, around that, slightly less than a year. And then your stocks didn't do well, okay? And what else? The rest just didn't do as well as during normal times. Then if we move to the peak of the hyperinflation, this is where you start to see that your energy stocks continue to do well. This is your agriculture, right, which is also commodities related, and then your precious metal, which is your gold. Okay, so you can see for a lot of the situation, right, it doesn't mean inflation gold will do well. Actually, it doesn't. You have to wait until hyperinflation, then gold prices will shoot up. Okay, so gold is probably the only hedge for hyperinflation. That's the only use of it. Other than that, make your iPhone and your gold jewelry. That's not very useful. Then your energy stock will still benefit in the hyperinflationary period, right? And you can see, if let's say we move into hyperinflation period, your stocks will do the worst in all different kind of scenarios. Okay, your REITs, where's your REITs? Your REITs will also be down. Okay, so another big paradigm shift I want to share today is also that REITs may not be as safe as you think it is. It may not be as defensive as you think it is if we move to hyperinflation. Okay, normal inflation is still okay. It will just be muted performance. But if we move to hyperinflation, REITs also cannot help you. Later we'll discuss a bit more on that. We'll go through every single asset class. Right. So you can see that investment approach 180-degree change. Okay, between normal time and hyperinflation. During normal time and inflation got some difference, but it's not very big. Okay, it's not as big. Just that a lot of investment don't do well, right? Then your energy stocks does very well. Okay, that is the only key difference. But once you go to the hyperinflation kind of a period, a lot of things change and at very extreme numbers. Okay, so that is the idea that I want to see in your mind, right? So just now I asked you about staying in cash, right? Whether you put money in the bank account. Okay, so I share with you that the bank interest rate will go up as the interest rate go up, but they will not go up as fast as inflation one. The bank interest rate will never help you beat inflation, I guarantee. All right. So which means that you will still erode your purchasing power if you leave too much cash in the bank. Okay, so that's why I say just now, right? Even though it's at 7% interest rate, the inflation was 10%. So you actually lose 3%. This is real case. This is not a fictitious case. All right. This is a real case. Real case. Okay. Oh, am I breaking up? Am I breaking up? Vincent said that I'm breaking up intermittently. I hope I'm not. Let me see. My connection is full bar. Okay, let me know if there's an issue. Then maybe I need to log out, log in again. I'll just carry on for now. So this is something that you must understand. So don't be so happy that the interest rate goes up. Okay, and the other thing is that if this interest rate go up, right, you'll be sure that your mortgage loan, your car loan will be definitely more than 7% one. Okay, all right, will be more than that already. Okay. Which is actually scary. Right? Can okay. I hope we not go there. That's why I think that if we ever see this kind of number for savings account interest, right, we are in terrible trouble already. Okay, so let's not hope to see again. And some people think about how about topping up CPF, right? Safer government guarantee, and then the interest rate is guaranteed. At least I won't lose money in this kind of very dangerous times. OASA rate are still at 2.54% respectively. There's no intention to raise it. They never say they're going to raise it, even though inflation is higher. Okay, so let's say you top up the money, right? And then they don't raise the rate, right? You want to withdraw, you also cannot already. Okay, so I don't think it's a good idea, right? It is very at the mercy of how they're going to decide what the rates are, right? So personally, I won't do that. And how about bonds, right? So people will think about bonds. Just now we will go through. If we go to hyperinflation, it is bad for bonds because interest rate goes up, bond price falls, right? And we also saw during the stagflation period in the 70s, bond price actually did worse than a lot of other asset classes. Okay, and even the shorter term kind of bonds, they seem like they are less volatile. Okay, the problem is that the interest that they pay you in a bond may not even cover the capital loss. So let's say they pay you 1% interest, but then you lose 3%. So you still lost 2%. And then you still have to stuck there for until the bond mature, right? 1 year, 2 year, 3 years. Okay, so that is undesirable as well. And just now Louis showed you the high yield bond, right? High yield bond is actually junk bonds. Okay, they will perform the worst because during this kind of difficult period, especially when there's a lot of risk going on in the markets, people will be scared. When people are scared, they will think of like put their money safer, and they will avoid the risky assets. So junk bonds, high yield bonds have been sold down since last year, and I think will continue to go down. Right? If the market continue to be risky, but if the market recovers, goes back to normalcy, then yes, junk bonds will recover. Okay, but otherwise, if hell break loose, junk bonds is going to lose more value than what they have in the past 1 year. Okay, so investor will fly to safety during crises, and the only really good bonds are the investment grade government bonds, like Singapore bonds, US bonds. These are Singapore is AAA rated, right? So all these are investment grade bonds. Okay, so these are the safe havens, right? People don't go and buy junk bonds one. If the market is crashing, nobody will go and buy Evergrande bond one, right? Even now, you also wouldn't think of buying Evergrande bond. Okay, so unlikely, right? So they will put somewhere safe, and usually they will flight towards the higher quality bonds. Okay, if they are going to buy bonds. So generally, bonds are not going to do well if interest rate is still going up. Okay, but I show you something that's very interesting, right? So I told you that during the 70s, they were raising interest rates, right? And then the returns actually eventually go up after they start to cut interest rate. So this is the period where they raise interest rate. Okay, this is the period where they raise interest rate. So you can see when they raise the interest rate, the bond returns are pretty bad. Most of the years they are negative one. Okay, this is what I mean, right? But after that, they start to take out the interest rate because the inflation is no longer a concern, right? Inflation rate actually come down. Okay, then the bond return actually shot up. Okay, so how do we look at this? Is that your bond, how it works, right, is that they will increase interest rate. Let me just play out the scenario for you. Let's say increase the interest rate, your bond prices will fall. Your bond prices will fall because the initial bond that offer the interest is lower than the new bond. Okay, let's use bond A. Then we got bond B. That's issued later. Right? So let's say bond A has an interest rate of 5%, and then bond B has an interest rate of 7%. Of course, the 7% bond, if all things being equal, 10-year, everything is the same. So of course, bond B is more attractive. Why would people want to buy bond A? Okay, so the bond A price have to fall in order for the yield to maturity to be about 7%. Right? Because when the price fall, the yield goes up. Okay? Instead of buying the bond at $100 at par value, you buy it at 90, you get a discount. So when you pay for a discount at the end of the maturity, you get back $100. So there's some capital gain in there to make up for the lower interest rate. So your yield actually shoot up to 7% for a year to match. So the older bond will always match the new interest rate, the newer bond issues. And they do it by lowering the price in the secondary market so that you can buy and sell these bonds. Right? So that's what happened when the interest rate is rising. Okay, your newer bond will get higher and higher interest rate, then your older bond will get cheaper and cheaper to make up for the yield loss. Okay, so that's what's going to happen. It's happening already, right? And it's going to happen because in Federal Reserve is still going to increase interest rate. Okay, so you'll be sure that the older bond prices will come down. Okay, and then the newer bond will be issued at a higher interest rate, right? And then people will go for the newer bond, and then they will dump the older bond. Okay, and that's why the price goes down as well. Right? So if they continue to do this, at one point in time, the bond prices is going to be very low. Right? The yield is going to be very good. The interest rate from the bond is very good. Okay. If let's say hypothetically, a Singapore government bond, 10-year bond, maybe 10-year too ambitious, 20-year bond, right? Give you a 8% interest rate. Okay, or yield to maturity, right? Either one. Okay, interest rate 8%. Would you buy or not? Backed by Singapore government, investment grade AAA, every year give you 8% interest for the span of 20 years. Will you take or not? Would you take it? Yes? When bond return shot out in the 80, then I suspect equity probably went up more relatively. No. Stocks, or in the 80s, later, if we have time, we see the data. All right. 70s, they didn't do well, of course, together with the bonds. How will you buy? Only one person buy. The rest won't buy. Better buy then put money bank. Then put money in the bank. Okay. So if you ask me, right, I think at one point in time, especially when the interest rate regime change or the inflation rate is no longer a concern, that is where your will be the most golden opportunity to load up these bonds. Yeah, because you lock in a high interest rate that you will probably never see again until another high inflationary period come about. Okay, it's very rare, right? So because during this, when they raise interest rate, right, the bond price keep going down, the yield keep going up. At some point in time, they suddenly realize that, okay, it's enough already, let's reverse. And then they start to cut interest rate. Then that's where your bond price shoot up. And yet you still get a high interest rate coupon. It is a very, very good opportunity, right? So I would say that now is not a good time to buy bond, but there will be a good time that you will lock in a high interest rate with an investment grade bond that you don't need to worry until maturity on. Okay, and you get capital gain somehow because you might buy below the par value. All right, so that is the idea that we are talking about here. So bonds, they are not a good investment now with rising interest rate, but at one point in time when they stop increasing the interest rate, right, and in fact they may reverse and go down, cut the interest rate, right, that's the golden opportunity for you to load up the bond at very good interest rate. Okay, so watch that space. Now, where are we now? Singapore long-term bond, 20-year, we are looking at 3% yield to maturity. Okay, I think if you double from here, right, 6%, you can start to look at it already. If the yield to maturity, the focus is yield to maturity, okay, not the bond coupon rate. You can see when they issued the coupon rate was 2.375. Now the yield to maturity is 2.989. Right? How do they compensate this? The older bond was the older bond issue at a lower rate, right? The older ones, the newer ones at a higher rate. So that is why you see the price came down. Right? The par value of Singapore government bond is $100. So they give you a discount, $92. So you get this almost 3% yield. Okay, so that is how the marketplace. And what's the liquidity like when you want to get out of it? There will be a spread to pay, but you can sell it like a stock, right? You have a CDB account, you can sell it. Custodian account also can. Okay, you sell it like a stock. Right, so you watch this, you watch the yield to maturity. Okay, so that is where once it cross, what is ridiculous? Singapore government bond giving you 6%, 7%, 8%. This is unusual, right? Because we know that the interest rate from a Singapore government bond is very low, 1-2%. That's all. Okay, at beyond 6%, which is like a dividend yield, high a REIT lah, right? Like a REIT dividend yield, right? Something is not right already. Okay, right. So that is the point that you start to see that, okay, this is getting interesting, right? There's a golden opportunity. Okay, this kind of thing doesn't come every day one, right? It comes 50 years ago. Okay, it has been 50 years since we see this. Okay, so it becomes a golden opportunity. So I believe that no matter how tough the economic outlook or the situation is, right, there's always opportunity, right? Just whether we are able to spot it. Right? So this is one of the golden opportunities. Okay. In the meantime, since we are waiting, right, and then you feel that, but I'm very scared. I don't want to invest so much. I want to park my money somewhere safe. Then I would suggest you Singapore savings bond. Some of you already have some, right? Because there is a limit how much you can put. I think it's 100,000, right? 200,000. Okay. So some of you might have already maxed out already. Some of you might not have even started a single dollar. This is something that you can consider now because it has a very special characteristic. The special characteristic is that it has no bond price fluctuations. It has no bond price fluctuation. It's always at par value. If you buy at par, you will always sell at par, regardless how the interest rate move. Even if the interest rate go up a lot suddenly, your bond price won't fall one. Because this is, I don't know a monster that was created by MAS, okay, because people don't understand how can bond price fluctuate one, right? So they don't understand that interest rate changes, bond price will fluctuate, and then they created this SSB just to fix the bond price. It doesn't move one. Okay, the only thing it moves is the interest rate. Okay, so how it works, right? You can see that you just focus on blue line. So it's a 10-year bond. It's a step up 10-year bond, which means the first year your interest will be lower. Then after they step up, right? Average is now is about 2+%. Okay, so you can see it already started to rise already, right? The interest started to rise. Is the 10-year yield is about 2.5% if I'm not wrong. Okay, 2.3, 2.5 around that region. So it will continue to go up if the interest rate goes up. Okay, but remember I said that interest rate go up, your bond price go down, right? Technically, but this one, because the SSB bond price always stay at par one, you will not lose money one. Even interest rate go up, you will not lose money one. Okay, so that's why I say this is the safest place to park your money now if you don't want to deploy it in your investment. Anyway, there's no lock-in period. After next month, you can withdraw your money. Let's say this month you put in, next month you can withdraw, right? As soon as next month. Okay, so it's not like fixed D. Fixed D you withdraw got penalty. This one has no penalty. Right? Just that you don't get the interest. You need to stay in the bond for minimally 6 months to get your interest. Right? But it's more like to protect your capital, okay? And at the same time, if you are able to hold longer, then your interest will definitely be better than the savings account or any fixed D. All right, and it's very convenient. You can use your local bank account and your CDP because the SSB will be stored in your CDP. Okay, you cannot be a custodian, so you need a CDP account. And any local bank, you use ATM or internet banking, you can do it. right? So if you do it, if you buy this month, next month you get it. If you sell this month, next month you get back your money. So that's how it works. Very simple, right? But this is where I think it's safe to park your money at this point in time, precisely that the interest rate movement doesn't change your bond price. Okay, so that's done with the bonds. But now let's add in stock bond asset allocation. Okay, so this is one of question coming from Kang Hao, and he said that how are the other strategy performing, especially those more defensive portfolio, right? Like all weather portfolio, permanent portfolio, or those very simple 60-40 portfolio. Luis already showed you just now 60-40 portfolio, right? Over a long time is fine, right? But during this period, it didn't work well. Okay, so same as the other portfolio, because they're all formed by the same principle, stocks and bonds, right? Primarily because of that. Okay, and let's look at some results, right? So he mentioned Bogle funds, Bogle H3 funds, right? It's 50% in Vanguard US large cap, 30% in developed markets excluding US, and then 20% in bond. Okay, so let's just focus on the past 1 year, right? You can see is negative, right? It's not just stock went down, your bonds also went down. Okay, by right, the relationship should be like that. Stocks go down, bonds go up, and that's why your financial advisor tell you to split your investment between stock and bond. But unfortunately, this advice doesn't work in this period where interest rate is going up. Later, I also will show you under what condition this kind of asset allocation will not work on. It doesn't work all the time. It works most of the time. It doesn't work some of the times, right? So, but of course, over a long time, it will work most of the time. That's why it goes up. Okay, but during this kind of period where there's a high correlation between stocks and bonds, stock go down, bond go down, stock go up, bond go up, right? You will not enjoy the diversification benefits. Okay, so this period is a period where diversification will not save you one. Okay, all right. Oh yeah, so thank you. There's a $2 transaction to pay for when you apply and redeem. Right? So there's a transaction fee, but it's a fixed fee. It doesn't mean you pay more if you have a bigger quantum to put inside the SSB. Okay, but let's come back to this. So what my point is that now, because they are all correlated, okay, your modern portfolio theory falls apart. And that's not just your advisor funds, but also all your robo advisors, because robo advisor work on stock bond diversification. It's still the what they call it, the MPT, modern portfolio theory. Okay, it doesn't work for the past 1 year, and it's unlikely to work in the next 1 year. Okay, so the robo advisor, I suspect the performance will continue to suck for another year at least, as long as the interest rate is going up. Okay, or inflationary period, basically. So this is a 60-40 portfolio, 60% put in stocks, 40% put in bonds. Same thing, 1 year negative. All right. Yield endowment portfolio, something different. They at least try to put something is inflation, right? Tip is inflation. Okay, so that's why their loss not as big. But otherwise, still pretty much stocks and bonds. Okay, pretty much stocks and bonds. All weather, this is from Ray Dalio, a simulation of his. Okay, at least it has some inflation hedge over here, right? That's why again it didn't lose that much. Okay, but if it's pure stock and bond, you can see the losses are bigger. Okay, can then this permanent portfolio, same thing. It has inflation, and it has quasi cash, right? Very short term bond, but almost like cash lah. So that's why the loss also lower. Okay, only 25% in stock, 25% bonds, right? Definitely more defensive. Okay, so this is the stock bond correlation that I'm talking about, right? But before I go into that, so basically, the thing is that all your whatever how you allocate, if you are still premising on that stock bond diversification idea, is not working for this period, right? But over the long run, it will. When they go back to normalcy, it's going to be fine, right? But not now. All right. You can ride through the storm, okay, if you still want to do it long term. But if you just want to do this for short term, then I tell you better not. Right? It doesn't work in the short term. It only work in the long term when the market go back to normalcy, when the economy goes back to normalcy. Okay, How about staking USDC in hold not? Okay, later I will cover. See, today we'll cover all the asset classes. Right? If I miss any, you can ask later some more. Okay, it's covered. Okay, next one. A stock bond relationship, right? Correlation. Basically, just remember, right? Your stock bond relationship will correlate during inflation, which is now, and deflation. Okay, so only these two periods. That's why normal time, your stock go up, bond go down is normal. Okay, but when it is an inflation period, your stock and bond will move together. You can see this is the 70s, move together, right? This is the correlation basically. So you can see that the periods, there are some periods they are correlated, there are some periods they are not correlated. So you can see the modern times, the recent history, we see some non-correlation, but actually in the late, I think about 2017 onwards, they start to correlate again. Okay, they start to move together again because they cut interest rate. The market rallied, stock market rallied, then the bond prices also rallied, right? Because interest rate goes opposite to bond prices. Okay, then now it's still correlate because they are in the inflation period, right? So that is how your stock bond correlation is not static one, it's dynamic one, depending on the economic condition. Okay, so unfortunately right now, stock bond correlation is not working. Okay, they are too correlated. And so conclusion, bonds have taken a hit as interest rates have gone up, didn't cushion the drop in stock prices, right? So that's why you get double whammy. Stock come down, bonds also come down. You do rebalancing, also no use. Asset diversification didn't help. And then the last thing is that if you look long term, it's fine, right? Long term returns, you can see that over 10 years, they're still positive. Over 10 years, they're still positive. Over 10 years, in fact, over 5 years, they're all positive. Let's say a shorter time. See 5 years, 8%, 5 8%, 5 years 7%, 5 years 7%, 6%. Okay, so pretty much still decent. That's why I say if you want to get return in the next 1 year or so, or 2 years even, unlikely lah, because they're very correlated now. But if you stretch it 5 years and beyond, you should be fine. Okay, so it's more for long term. So if you're on a monthly or a dollar cost averaging with your robo advisor or your advisor right now, don't stop. Okay, if the plan is to do long term, don't stop, continue. Right? If you just do it for fun, you just want to do it for just 1-2 years to test water, then I tell you don't do it. Okay, you're going to give up anyway. All right, so that is the scenario over here. Okay, so the last thing is that no matter how you allocate right, not important okay, whether 50% stock, 20% bonds, all this not important, because over the long run, right, the returns are more or less the same one. Okay, yeah, it doesn't matter, right? So don't major in minor things. If you want to do those stock bond portfolio allocation, do it all the way. Okay, and just choose one and go with it. It doesn't matter. The long-term returns are not going to differ too much if you allocate differently. Okay. Right, REITs, your favorite asset class. Okay, so Tang Hao is suggesting whether REITs are better, because you feel that you hold cash also not good, right? Because inflation will eat into your purchasing power. So how about putting in REITs? So REITs, now it is affected by rising interest rate. Why? Because rising interest rate, your financing cost goes up. Because REITs always borrow money, right? Property are capital intensive, they need to borrow to fund their property purchase. And when financing costs go up, means they have less money to give you dividends. So dividends will go down. Okay, so that's the inflation part or the rising interest rate part. And then the next thing is that we talk about possible stagflation, right? Which means recession may come in. If recession come in, means that more businesses will fall, spending may go down, and tenancy will go down because this is your source of revenue, right? So if the tenancy go down, they can't get a good occupancy rate, then your dividends also go down. Okay, so it has two headwinds that is facing REITs at this point in time. And that's why REITs have also not been performing well for the past 1 year. Okay, because the market is predicting the interest rate going up, and indeed it went up, right? So the REITs cannot go up. It has a ceiling, right? It is keeping it down. And then with possible recession, is even worse. Okay, the occupancy rate may come down. Right? So if we continue like this, it's actually not that bad. Okay, it's actually not that bad, because REITs, even though it doesn't go up, right, it doesn't go down a lot, and you still get the dividends. Even though they may cut the dividend, but still there's dividend. Right? It's not that bad as if you buy bonds, the returns will go down much faster, right, as compared to REITs. Okay, so that's all good. But if let's say you go to inflation, high inflation rate, right? High inflation, the hyperinflation that we're talking about, interest rate go up even more, then you got problem. Okay, so now let's say just to talk about government bond, right? Singapore government bond, very highly investment grade one, high investment grade one. Okay, then let's say, right, because of interest rate going up, your bond yield, your Singapore government bond is giving 5%, hypothetically, and your REIT is giving 5%. Which one will you invest? If the Singapore government is issuing bonds that is paying you 5% interest every year versus buying a REIT for 5% dividend yield, which one will you choose? The government bond or the REIT? Government bond, government bond, government bond. Right? Logical, right? It doesn't take a genius to know that why would I want to take the risk when I get the same return? Correct? Okay. So that is my biggest worry about REIT. Right now, it's still okay. Right now, it's fine because the bond yield is not higher than the REITs dividend yield. Not yet. Okay. Whether we'll go there, I don't know. Right. But I'm just painting you this scenario. If it goes there, your REIT, what will happen to your REIT? Your REIT price will go down. Right? Because people dump the REIT, then they go to the bonds. People flight to safety. That's what I'm talking about. Right? People will see that, hey, why in this kind of climate, why would I still want to take those risks when the interests are going up? So that's why I say the what we have experienced in the past 10 years is going to be very different. What is going to go forward? Okay. We need to get used to this new normal. Right. It is not normal. It's not the last 10 years normal. It's a new normal that's going to go forward. Okay? Whether we'll go there, I don't know, right? But it will cause some havoc over there. And let me just see. Okay. Uh, Maybe we can take a look at this first. Okay. So currently, these are the forward yield. Forward yield means the next 1 year dividend yield forecast by the analysts, right? So these are the higher quality REITs. Okay, I put it over here. These are backed by very strong sponsor, almost government backed one. And you can see that forward yield is about 5+%. Okay, this is what I mean. If let's say the bond yield, Singapore bond yield go to 5%, right? All these will not look as attractive as what they are right now already. Okay, so that is something to watch. Now, bond yield is at, you use the 10 years about 2.5%. Okay, there's still a range, right? They need to double. Okay, uh, still quite far, right? Still quite far, but it's not impossible. Okay, it's not impossible. But don't write off REIT. Let's say you have invested in quite a number of them, right? Or you're intending to invest in them. I would think that the Singapore properties, those that are local ones, those REITs with local properties, they should have a better rental resiliency. Okay, especially during COVID, you can see that Singapore tided it through a lot better compared to a lot of other countries, right? So I believe that it will continue to do so. Okay. And you will continue to receive dividends. Even if they cut the dividends, you still receive them. You just continue to ride the tough times. Because eventually this whether is it hyperinflation or inflation or stagflation or recession, it will be over at some point in time. And your investment horizon can be longer than this uh, unfortunate events, right? Likely. Okay. Unless your investment horizon very short, then that's a different story. Okay. The longer the horizon, the more you can ride it through. Right. And the other way is that if you want to buy REIT, maybe you can wait further, because if let's say the interest rate really inch up closer to the dividend yield of these REITs, the share prices of this REIT will go down. Okay. So how will it affect, right? So when, let's say hypothetically, if the Singapore government goes to 5%, right, your REIT dividend yield will not be 5%, it will be higher than 5%. Because this is riskier, right? Riskier should compensate with higher return. The market always behave like that. So how does the REIT increase this yield to you? When, if let's say we talk about, their dividend is going to get cut because of higher financing costs and lower tenancy, how do they give you higher yield, right? Dividend yield, remember, is by this relationship. It's same as bond yield just now. But I use this to explain this easier. Dividend per share divided by price. Right. So what I'm trying to say is that if the bond, is giving 5%, your REIT dividend yield will shoot out one. Okay, because it's riskier. It has to be higher return one. It has to be higher than 5%. And to do that, your dividend per share goes down, right? Because business not good, inflation reduces distributor income. So the only way for this yield to go up, right, is for the price to crash. Logical, right? Your price must crash more than the dividends reduction. Then your yield will shoot up. Then your yield, maybe your dividend, imagine a REIT, right? Maybe a capital land REIT give you 10% dividend yield. Okay. Then there is some delta, right? There's a good reasonable delta, right? Then you might invest in REIT. So let me ask you, if let's say the government bond is 5%, but then now the capital land integrated commercial trust is the price have crashed and the dividend yield is 10%. Which one will you buy? Will you buy the 5% government bond or you will buy the REIT with 10% dividend yield? Which one will you buy? Which one is more attractive to you? Okay, REIT. Because inflation much higher, right? If the government bond give you 5%, it might not even be inflation. Okay, read already, right? Okay, so this is what may happen, right? Yeah, so there are two things that may pan out. Okay, of course there can be more scenarios, but I'm saying that likely these are the two scenarios that will pan out for REIT. The first one is the inflation is just normal. It just maintained as it is. They raise the interest rate to a certain level, then they stop. Okay, all things is good. Yes, inflation rate can still be high, but everything seems stabilized. Right? Maybe there's a recession, there's a very mild stagflation. Then your REITs will be okay. It will not go down a lot. It will not go up, but it will not go down a lot. You will get some cut in the dividend. You receive less dividends. Okay, this is a good scenario. This is actually a good scenario. The bad scenario is hyperinflation. They keep increasing the interest rate. Okay, push the bond yield to 5% or more, right? Your REIT price will fall. Okay, the yield for the REITs will shoot up to a certain level to attract buyers coming in. But during this increase in interest rate to push up the bond yield, in the meanwhile, your share price, your REIT price will keep falling, right? And today it fell very badly, right? Okay, not very badly, badly. Okay, it's not usual to see the REIT under, even Keppel DC REIT is below $2 already. At one point, it was above $3. Okay, so it's been declining for the past 1 year. So this still considered a stable period, right? If let's say you go hyperinflation, the REIT prices will fall more. So this is something that I think people have not imagined that is possible to happen, right? They always think that REITs are very safe. It's like the last fought already, because a lot of things have fallen already. Okay, REITs although have fallen, but it's still quite reasonable, right? And the yield is still quite steady. Okay, but this is something that we need to watch out for. Can So your bond yield actually will change a lot of things, okay, because that's your risk-free rate. Can and that's why I say that if you want to pick the REITs, right, choose the higher quality Singapore focused REITs, right, with strong sponsor. This will be the theme I will focus on, not your very risky small cap kind of REITs. I don't think they are that resilient. If let's say the environment become very hostile towards REITs, right, you want the sponsors to be able to step in to save the REIT, okay, if it's necessary. Okay, so these are the ones, right? I think you can see these are probably your popular ones, right? Lendlease, because the sponsor is quite strong, even though it's an Australian company, but they have very good property development experience. Large sponsor as well, right? Mapletree, don't need to say, this is Temasek company. And Capital Land, same, Temasek link. Fraser, we got your Thai Bev people behind it. Is it Thai Bev? I think so, right? They bought over FNN. Yes. Then your NetLink also Singtel related, and Capital DC also backed by another GLCs, right? So these are the ones that they have majority of property in Singapore. Actually, you still get one more, right? Ascenders. Ascender is more, they have more properties all around the place, but also because same parent, Capital Land. So these are the ones, right? So another golden opportunity, right? Just now we talked about the bond yield. If the bond yield shoot to 5-6%, right, for investment grade bond, right, it become a once in a lifetime golden opportunity to buy them, right? Load them by the truckload. Then the other one is this. Okay, if let's say the second scenario play out, hyperinflation, right? This one, okay, hyperinflation, and the bond, REIT crash, right? Bond, the dividend you shoot to 10%, right, or more, for this kind of REIT, okay, for this high quality REIT, if their yield shoot out to 10%, for these REITs, buy them. Okay, same principle. You lock in that kind of dividend yield, you lock in that kind of very low REIT prices, and then when the market stabilize, right, you get both capital gain and very high dividend payout. Okay, you never get this kind of chance, right? Maybe during a market crash, then you get this kind of chance, right? So you might get this chance again. Okay, so I don't know which one you wish for, right? Whether a normal inflation or not so manageable inflation, so the REITs is just muted performance, or you want a hyperinflation to cause the REIT prices to go down. Okay, I think it depends on whether you are holding REITs. You are holding REITs, you'll prefer the first scenario, right? Don't go down so much, right? Just pay me dividend. But for those who are not heavy in REITs, then you're probably hoping for, wow, if crash, I'll go in and buy. Okay, so depends on which camp you are in, right? So either scenario can happen, but it's too early to tell where we are heading to. Okay, next one, Singapore property, right? I'm talking about the physical properties, and I just try to this is the price index, the property price index, and this is the lending rate, bank lending rate. Okay, because property are usually leverage play, you take mortgage to buy properties, right? So the prices in Singapore property has been going up. Yes, there are some bumps along the way, but generally the trend is on the uptrend, and interest rate is on the other direction, it's on the downtrend, which is a good sign, right? Because lower interest rate means more people can afford to buy houses. Okay, so interest rates since the 80s or the 70s have really just dropped, right? You can see this is a lending rate in Singapore, not US, but the profile is similar to the US interest rate. Okay, that's why I say we will inherit the interest rate, right? If US raise the interest rate, Singapore will raise the interest rate, right? Okay, because we benchmark against the currencies, right? So this is one key thing. But we also know that the mortgage rate has been climbing up. Okay, and if interest rate go up, the the mortgage rate will definitely go up. Okay, it may affect some of the affordability for some people, but I think the overall demand will not be tapered too much, right? Because Singapore is a very popular place to buy properties, right? Even in the region or even from China, because we have proved ourselves to be very stable, okay, in this region, and our property prices have been very resilient and trending up. So it becomes a very ideal places for people to park a lot of money. Okay, so I think this will not change, right? Even in fact, Singapore will even be more attractive if, let's say, the markets around the world, especially in emerging countries, are wrecking their economies, right? More will flock to Singapore, not less. Okay, so it's actually good for Singapore. If the if the world economy is in shambles, right? Unfortunately, and Singapore properties do have some headwind. One is, of course, the ongoing cooling measures and rising mortgage rates. Okay, but I also share with you that it's going to be resilient because the fact that, right, the cooling measure, right, has never been lifted, has never been really relaxed by a significant amount, even during COVID, and yet the demand is still there. So I can tell you the property market really can absorb one, right? So it is not a problem. Financial means is still present. There's also influx of foreign buyers, right? With all the travel restriction lifted, it makes foreign buyers visiting Singapore a lot more easier than ever before. So the buying may come back. So I think that the Singapore property market is going to be resilient. How about, let's say we go into hyperinflation, like what we discussed for REITs? What will happen? Then yes, your mortgage rate will shoot through the roof. Okay, that such that, wow, it's crazy. Why would I borrow so much at such a cost to buy properties? But at the same time, right, the property value will also go up a lot. Okay, because it is hard asset, right? It's a hard asset. It's going to appreciate with inflation. So that is another positive sign, right? So yes, maybe only the rich who have more affordability or more spending power can continue to buy properties, and then the mass market will struggle more, right? So that is one possibility, and then your high-end properties will still continue to do well, but your mass market property may not do as well, right? But if you're holding on to one, you may see the property prices going up. You still get a net worth gain, right? Just that buying another one or doing more investment in the property sector may be challenging, right? May be challenging depending on your spending power. Okay, so but I think that overall the Singapore property market will still be very resilient one. All right, so that's one positive side. Okay, how about gold commodities? Right, I lump them together. Wen Chong was asking, right? Is it good to keep the gold ETF? Because recently I sold the gold ETF because it dropped below the moving average. That's our momentum sell rule, right? And somehow this gold just didn't pick up in this event. It did pick up when Russia invaded Ukraine. Then after that, it just lose steam already. Just go below moving average. I think we just break even now. We didn't make anything, so we are out. But he's thinking that what would gold be good? Okay, so let me ask you, will gold do well in recession? If you have been listened attentively, you actually know the answer, right? Would gold do well in if there's a recession? Would gold do well if there's a recession? Yes, no, yes, no. Never mind lah. Not wrong also never mind. Won't get punished. Right also won't get prizes. Okay. Precious, yes. Precious, no. Okay. Only hyperinflation. Okay. Yes. Okay. Only hyperinflation, not during a recession. Yeah. So at least you all learn some of this relationship, right? Then I think it will prepare you better. You know what to do, right? You know what to park your money, where to park your money. Okay, yes, it's hyperinflation, not recession. All right, recession, the gold will not do well. Okay, but if we go to hyperinflation, your gold will do well, your properties will do well. Okay, so you will realize that the investment will change. Those that do well in different kind of environment, and gold has not done very well. Just the year-to-date return is 1.5%. Okay, some people are speculating why gold didn't do this as well as before. I attribute it to maybe the rise of crypto because you have another asset class to absorb a lot of the money, lah, right? So fewer go to gold. Even though crypto is not a good inflation hedge, it's a terrible inflation hedge. Later I'll explain a bit more, right? But somehow gold didn't get that shine as compared to the rest of the asset. But remember, I said hyperinflation is good for gold. Okay, so if we ever go to that, right, which means if you want to buy gold, you have to have the belief that you think hyperinflation is going to happen. Okay, then you buy the gold, you hold the gold, right? Otherwise, I would suggest you just treat it as a short-term trade using momentum. If the momentum is not there, then you get out. If the momentum is there, you just stick to it, right? So only position for gold if you think hyperinflation is going to happen. Okay, if you ask me at this point in time, not clear, right? It's just a possibility. How probable? I also don't know. Really no sensing. Okay, but it is a possibility, right? So just have to watch how the inflation play out. Look at the numbers every month, and look at the central bank behavior, right? Are they going to increase interest rate faster? If that's going to be happening, then likely hyperinflation may be coming. Okay, so those are telltale signs, but now it's too early to tell. Commodities, on the other hand, has done very well, right? Especially oil stocks. Not only that, your fertilizers, your agriculture, quite a lot of them. But lately, the commodities are not doing that well, right? We see some drawdown, which is very different from a few months earlier. A few months earlier, the commodities have been going up while the tech stocks have been coming down. But recently, the tech stock has been going down, commodities also going down. Okay, so the size is a bit mixed, right? And we used to have the peak ETF, which is metals, right? It was the first one we have to sell because the momentum died off. Then the second one was veggie, which is agricultural stocks. That one also sold, right? So both have fallen below, right? But oil not yet. Okay, oil still holding strong. So some commodities are still running. Corn, soybean, all these are still there. Even though they're agriculture, but this agriculture is stocks. I'm talking about pure corn, pure soybean, all those kind of grains, wheat. So those are still holding up well. So it is a mixed signal, right? Still too early to tell whether the commodity run is over. Because for all you know, right, they can go down and come back out. Okay, just that now they are here, right? They may also go down lower, right? So if they go down lower, right, it will tell us that the inflation is likely to be under control. Okay, so another indicator is watch the commodity market. If the commodity prices are coming down, okay, that may be a sign that this inflation is under control already. All right, yes, coal is also doing very well. Okay, how do I define hyperinflation? I think like 10 over percent, 10 over percent inflation rate, okay, and more, right? With QT, there will be no hyperinflation, hopefully lah. Okay, it's too early to tell. I also don't know, right? But just have to watch how the situation pan out. But I think it's still useful to go through this because I think a lot of people never project the possibility of hyperinflation and how will your investment change. Okay, at least if it happen, you know what to do, right? I'm just preparing you. Okay, so still early. Commodity run is not over yet. Not at least not confirmed. That means that inflation is still around, right? And all the inflation numbers are still consistent. All the hawkish policy are still consistent with what is going on right now. Not been solved yet. We are not out of the inflation problem yet. Okay. So next one, how about crypto? Right? Crypto has been hogging the headlines for the past few days. All the stable coins. For those of you who are involved, you know. For those who don't know, also never mind. Just listen can already. Okay. Not necessary everything you also must do. Right? So the question from Inquang is that is it safe to hold USDC, USDT in hold not? Right? There was another question in just now that was put up, and or better to hold US dollar. Okay, so let's talk about this, right? So stable coins is having a crisis right now. Your UST has lost its peg. I don't know. I think now it's half, right? 0.5 to one USD is 0.5 US dollar, okay, equivalent. So it's supposed to be matched $1 for $1. So half, right? It's like your country's currency just devalued like that. Okay. Things like this happen in the real world. It also happens in the cryptocurrency world, and that's why it's causing a lot of commotion over there because people don't expect it, right? Same thing. If let's say hyperinflation happens, right? I can tell you a lot of people don't expect it, and then they were all in shock. Why is this happening? And everyone will be talking about it. And my thing is this, right? If you don't need the money and you have already parked there, you have been staking it, there's no urgency to withdraw it. If it's not, especially it's not a big amount, you're not worrying about it, I think just leave it there because they can restore parity, right? They can restore the peg. Okay, it's not necessary that they will stay like that. Of course, if really this crisis spiral out of control, it can go to zero. Okay, there is a possibility, right? But I think more likely is that they should be able to regain the peg because these things have happened before, right? Unpegging, depegging has been happened before, especially during COVID. Right, COVID they lost pegs, but then they restore it. So I believe that it should be able to restore. And if you're worried, if the price rebound because they've been very volatile, yesterday can go to like 70 cents, then after that go back to 40 cents, then after that go back to 90 cents, right? They just very volatile. Actually, very good for trading. They'll be very volatile. If they rebound to a high enough price, you sell, right? Then you withdraw the money, get out of that system. Okay, then at least you keep your money safe, right? So it depends on how much you have as well and how worried you are. So that's why there isn't a very common advice or recommendation for everybody, right? You have to, it depends on the situation, okay? And then next today was USDT, Tether was the other one that looks shaky. It has depegged slightly and doesn't look as stable. USDC and BUSD are the ones that are more stable right now, right? So I would say that you probably look at these two if you still want to stake your money, all right? At this point in time, they still look safer. I don't know what happened next week because things can be very dynamic. If you are worried, always find an opportunity to sell a rebound and switch to USD. Okay, and crypto is very correlated to growth stocks, especially the tech stocks, US tech stocks. Okay, very, very similar, right? You can see for the last 2 years or so, they have positive correlation, right? Especially with Bitcoin, okay, because each chart is related to Bitcoin, but Bitcoin move, the rest also move one. It's also in tandem, pretty much. They're all correlated in that sense. So tech stocks are not doing very well. Your crypto has not been doing very well. They have lost, a lot of them have lost more than 50% of their value already from the peak. Okay, so this is common, and which means that it's not going to be an inflation hedge. It's not going to be a hyperinflation hedge. It's just behaving like tech stocks. Okay? Probably because the same people who do those high growth tech stocks are the same people who do crypto, right? Likely they are in the same wavelength, right? So maybe their behavior is driving that correlation. Okay, and the stablecoin disaster, right, will take some time to recover, right? The confidence, investor confidence must be there, especially with those affected one, UST especially. Okay, the confidence will not come back so fast one, right? Last time the DPEC took a few weeks, I think 2 weeks, right? So this time round only a few days, haven't done yet, so still early. Okay, will people put more into UST? I don't know, right? But there's definitely going to be a major change to how this stable coin is going to be in the future, right? They know that the old way of doing things is not good. There's a loophole. There were rumor that someone attacked them, right? Which is Citadel, a high frequency trading company, right? But we don't know what's going on exactly. Okay, that is possible, right? But definitely the investor confidence will take some time to come back. And if let's say you have other tokens, that means beyond stablecoin, you have Ethereum, you have other kind of crypto. I believe that crypto is not going to go away. It will get mature. You get more maturity, right? Because right now they are learning a lot of things. They make a lot of mistakes, okay, including this stablecoin disaster. They will learn from it. They'll move on from here. They will develop more robust rules, right? And then I think the market will come back on, but definitely not in the short term. Okay, if you're a long-term spend, you don't need the money. I think you can just leave it there. All right, 10 years later, you just look for it or you leave it for your kids Okay, it will still worth quite a lot. That's my view. Yeah.